David Chen slept on the flight, first class, 11 hours, 51 years old. Total compensation last year, $2.4 million. This morning, he has 45 minutes. One person, one building, Edmonton, January. That person will sign a $500 million commitment into his fund, or she will not. She is 32, salary, $180,000. When David's car pulled up at 5:53 a.m., the parking lot had 3 cars. Hers was already there. He sent 2 emails last week. She did not reply to either. To understand why a man earning $2.4 million flies 11 hours for someone who did not return his emails, you have to go back 8 years. Floor B2, Sacramento. Fluorescent light, a gray desk, a microwaved lunch. The first morning you understood that the people who move capital are rarely the ones whose names appear on the fund. Level 1. The Investment Analyst. You are 24 years old, UC Davis, 3.7 GPA, 6 interview rounds, a 4-hour test on capital call mechanics, 1 offer. Not Goldman, not Blackstone. CalPERS, the California Public Employees Retirement System. 2 million beneficiaries. 0 interest in where you went to school. Base salary, $95,000, no bonus. Your father spent 47 years as a civil engineer in Fresno to reach that number. You do not bring this up. Floor B2, no windows. Fluorescent tubes, gray desks in rows of 6. No Bloomberg terminal, $25,000 a year for the license. And the budget committee has said no 3 years running. Your colleagues call it the basement, not as a joke. Monday mornings, 40 pitch decks, 60 to 120 pages each. Same argument, different fonts. Exceptional team, differentiated track record, optimal vintage entry point. Your job is to find the 2 where something in that sentence is actually true. You filter by J-curve trajectory, by vintage diversification, by a third thing your supervisor calls gut, which she says takes time. Her name is Margaret, 44 years old, 17 years at CalPERS, 12 feet away, $9 billion in approved commitments. Never raised her voice in a meeting. On day 1, she says, read a prospectus the way you'd read a contract written by someone who doesn't want you to find the clause that matters. Look for what is not there. You read, you filter, you note. 40 decks become 6. 6 go to Margaret. Margaret picks one. The other 39 receive a form email from an address nobody monitors. Behind each, years of relationship building, multiple flights, catered presentations at $400 an hour. Your side of that transaction, 12 minutes on a Tuesday. You stop noticing this around month 6. End of month 9. A managing director from New York calls, $8 billion under management, 22 years in private equity. He does not ask for Margaret, he asks for you. You pick up. You do not write anything down. Writing would mean you are surprised. You are starting not to be. Level 2, the senior associate. You are 28 years old, Edmonton, AIMCO, the Alberta Investment Management Corporation. Total compensation, $180,000. Minus 28 degrees for 3 months of the year. You do not care. AIMCO lets you sit in due diligence rooms. Not observe, sit. This week, New York, 38th floor, Midtown, walnut paneling. Across the table, managing partner, 2 MDs, head of IR, 61 combined years in private equity. Combined comp last year, somewhere above 11 million. Your side, you and Margaret, no ties. You ask about the denominator effect. The GP answers. You ask about vintage 2021 specifically. The GP revises. You ask a third time. Fee breaks for anchor LPs. The GP looks at the head of IR. The head of IR looks at the table. Margaret says nothing for 4 hours. Walking back to the hotel, she says, "They are afraid of us. Notice that. It is the most valuable thing in this room." That night, you write one line in your notebook. They are afraid of us. Then you call your brother. He asks when you are coming to see your mother. You say next month. You hang up and read the limited partnership agreement until 1 in the morning. You do not go next month. 1 week later, a side letter. MFN clause, fee reduction of 25 basis points across the full commitment period. Co-investment rights on transactions above 500 million. You countersign. You are 28. You have just extracted better economics than sovereign wealth funds 3 times your size received in the prior vintage. Nobody tells you this. You find it yourself 6 months later in a secondary data source. Level 3. The Portfolio Manager. You are 33 years old, Portfolio Manager, Private Equity, compensation, $320,000, $4 billion in commitments across 23 funds, 11 countries. Your calendar runs New York, London, and Singapore simultaneously. You stopped adjusting your sleep around year 2. This week, a top 10 global fund pitches Fund 8. Net IRR 22% across 4 prior funds. TVPI 2.4 times. Oversubscribed 60%. Allocation cap per LP 800 million. Your team has been offered 400 million. Pass. Not because the track record is soft, because you pulled the side letter from a Middle Eastern sovereign wealth fund in the prior vintage. Their MFN clause applies retroactively. Every improved term they negotiate going forward attaches automatically to their existing position. You were not offered that. By Fund 9, the gap will be measurable in the tens of millions. The GP calls 3 times, a principal first, then an MD, then the managing partner himself. 30 years in private equity, comp last year, approximately 6 times yours. He says, "Let's find a way to make this work." Pass. You set the phone down. If you have watched this far, this channel was built for people who want to see how the system actually operates. One subscription keeps it going. Back to it. Your mother calls that evening. Your father is in hospital. Elevated blood pressure. Not serious, but she asks if you can come that weekend. You say yes. You will book the flight tonight. That weekend, you are in Hong Kong for the annual general meetings of 3 funds. You send flowers. You do not go. Level 4. The Head of Private Markets. You are 40 years old, Singapore, Head of Private Markets at a major Asian pension fund. Base, $520,000. Phantom carry over 8 years. $38 billion across private equity, private credit, infrastructure, real assets. 6:30 a.m., London. 11:48 p.m., San Francisco. 6 calls between them, 14 flagged emails. 1 meal, the same room service salad for 7 months because it arrives in 20 minutes and your body stopped asking for variety somewhere around month 4. The rosemary plant on the balcony died in March. You replaced it with a cactus. Someone said cacti survive neglect. It is fine. You have not thought about this until now. The job is no longer about selecting funds. Any competent analyst anywhere runs that filter. The job now is structural risk. What happens to your private allocation as a percentage of total NAV when public equities fall 15%? What 17 funds approaching harvest windows simultaneously does to your liquidity. The scenario, not hypothetical, that happened in 2022. Public markets correct. Your private portfolio moves from 22% of NAV to 31%. Breaches the 25% ceiling in the investment policy statement, forces secondary sales at a haircut of 30 to 35%. You are not managing money. You are managing the distance between what the policy says and what the market does. On a Thursday afternoon, the CIO sends 4 sentences. He is retiring. 58 years old, 11 years in the role. The board contacts you the following Monday. You ask for a week. You take 4 days. You say yes. Knowing the role from the outside and the role from the inside are not the same thing. Level 5, the CIO. You are 50 years old. Base, $850,000. Strong year, 2.2 million total. $400 billion. 14 asset classes, 630 positions, 3.1 million beneficiaries. David Chen comes every quarter, same room, 45 minutes. Your team spends 3 days on his deck. You read the memo in 40 minutes, 6 questions prepared before he sits down. He answers 4 cleanly. The other 2, he promises in writing. He never sends them on time, not because he forgets, but because the accurate answer would complicate the commitment. You know this. He knows you know. 11 weeks later, his IR team sends a partial response that addresses neither question. You have watched this pattern with 43 fund managers over 9 years. The behavior tells you something about how a team handles inconvenient information when the stakes are real. You weight it. Your days begin with preparation for a body one level above you that holds authority you do not have. Every commitment above 200 million requires their approval. You do not sign, you recommend. You build the case, sequence the argument, present. Then 9 people vote. 26 years of judgment. The 9 people above you took a different path. That is not a flaw in the architecture. That is the architecture. The other side of the table, 9 people, average age 64, appointed or elected, no interview, no competency test. No capital call mechanics. A former mayor, a university provost, 2 union officers, a retired school teacher the union nominated, a property lawyer, a state government representative, a man who owns 4 restaurants. A woman who runs a trucking company with 11 vehicles and 34 employees. Not one of them can distinguish TVPI from DPI. One asks at every meeting, sincerely, what private equity is. Trustee compensation, $12,000 a year. Several receive nothing. They attend because the charter requires it, and because they take that obligation seriously in a way that is easy to underestimate until you have sat across from them for 11 years. 6 meetings a year, 4 hours each. Your slot, 20 minutes. 20 minutes to present what your team spent 6 weeks building. You removed all jargon above a middle school reading level by year 2. Not because the trustees are unsophisticated, but because jargon in that room signals evasion. The retired school teacher said so herself, calmly, in the 3rd meeting you presented to her. Simple majority, 5 votes out of 9. David Chen has never been in this room. He does not know that one trustee voted against the prior private equity commitment because a fund restructured a company and his son-in-law was in the first round of cuts. He does not know that the retired school teacher, 71 years old, reading glasses on a chain, arrived at the last meeting with 14 handwritten questions on a sheet of A4 after reading a Saturday article on fee waterfall mechanics. She asked all 14. She wrote down what you said. He will never sit in this room. He does not know it exists. $400 billion, 20 minutes, 6 times a year, 9 people earning $12,000 annually, casting 5 votes. The room was always there. It was there when you were 24 in the basement. It was there when you said pass to the managing partner who called 3 times. It was there the morning you signed your CIO contract and thought, briefly, that you had reached the top of something. The power was never where the compensation was. It was in a 4th-floor conference room in a government building, around a table with 9 chairs, where people who cannot define DPI decide where $400 billion goes next. Sacramento, floor B2. This morning, a 24-year-old sets her lunch bag under the chair, access card 3 days old. The fluorescent light flickers once, holds. She opens the first pitch deck of her career, a Wall Street fund, $8 billion under management. Sent by a managing director who earns 12 times her salary and has been waiting 4 days for a response. She has not responded. She is still reading. She does not know about the 9 people. She does not know the man waiting for her email flew 11 hours once to sit in front of someone who started exactly where she is sitting now. She reads, she filters, she notes. The capital allocation machine does not stop. It just finds new gatekeepers.